A bank that had survived 119 years, including the Great Depression, collapsed in a single day in September 2008, becoming the largest bank failure by total assets in the entire history of the United States, larger than Lehman Brothers, larger than any bank collapse before or since. The bank was Washington Mutual, commonly known as WaMu. Founded in Seattle in 1889, the bank had built, over more than a century, a reputation as a genuinely stable, customer-friendly savings institution, focused primarily on residential mortgages and traditional retail banking services for ordinary American families, expanding steadily through the 20th century into one of the largest savings and loan institutions in the country. Beginning in the early 2000s, as competitors like Countrywide Financial aggressively expanded into higher margin, higher risk mortgage lending during the housing boom, Washington Mutual's leadership made a deliberate strategic decision to pursue similar growth, significantly expanding the bank's own exposure to subprime mortgages, home equity loans, and a particularly risky product called option arm loans, which allowed borrowers to make minimum payments that didn't even cover the full interest owed each month, causing the loan's principal balance to actually grow over time rather than shrink, a structure that only made financial sense for the borrower if home prices continued rising indefinitely, allowing them to eventually refinance or sell at a profit before the loan's true cost caught up with them. Morgan Housel has written that some of the most dangerous financial products aren't the ones that fail immediately and obviously, but the ones that work beautifully for years, generating the appearance of sustainable profitability right up until the specific market conditions they quietly depended on shift, at which point the underlying fragility becomes suddenly and often catastrophically visible all at once. Washington Mutual's option arm portfolio exemplified this pattern precisely. The loans generated substantial reported profits for the bank throughout the housing boom, specifically because rising home values made borrowers' growing loan balances appear, at least on paper, to remain adequately secured by increasingly valuable collateral. Benjamin Graham's investment philosophy emphasized maintaining an adequate margin of safety specifically to survive being wrong about at least some underlying assumptions. Washington Mutual's option arm strategy operated with essentially the opposite assumption. The entire product's viability depended on one single, specific condition: continuously rising home prices, remaining true indefinitely, leaving the bank with almost no margin of safety whatsoever once that underlying assumption inevitably failed to hold. Daniel Kahneman's research into how a sustained period of success can cause institutions to systematically underweight the probability of a scenario that hasn't occurred recently, even when historical precedent suggests it eventually will, helps explain why Washington Mutual's leadership continued expanding this specific lending strategy even as internal risk indicators began deteriorating. The bank had generated substantial profits from option arm lending for several consecutive years, and that track record appears to have reinforced confidence that the underlying risk had been adequately managed, even as the scale of exposure to a genuinely singular, undiversified risk factor, continuously rising home prices, grew to represent an enormous portion of the bank's total loan portfolio. Robert Kiyosaki's core lesson about understanding exactly what risk an asset genuinely carries applies here with particular relevance to how Washington Mutual's own depositors and even many of its own executives appear to have perceived the bank's underlying stability. WaMu's reported profitability throughout the mid-2000s created a strong impression of a fundamentally sound, well-managed institution, even as the bank's own loan portfolio was becoming increasingly concentrated in exactly the kind of fragile, single-scenario-dependent lending that Housel's broader observation about hidden fragility specifically describes. As housing prices began declining broadly in 2007, and accelerating through 2008, Washington Mutual's option arm portfolio began experiencing a wave of defaults, as borrowers who had been counting on rising home values to refinance or sell profitably found themselves instead owing more on their homes than those homes were now worth, with monthly payments about to reset dramatically higher as the loan's initial minimum payment periods expired. Losses mounted rapidly, and depositors, watching news coverage of the broader banking crisis unfolding across the country, began withdrawing funds from WaMu at an accelerating pace throughout September 2008. This is where Washington Mutual's story intersects directly with a broader, systemic vulnerability affecting banks generally, the fundamental mismatch between a bank's long-term loan assets and its short-term deposit liabilities, the same underlying structural vulnerability that had already destroyed Bear Stearns earlier that same year. Once depositors lost confidence in WaMu's stability and began withdrawing funds rapidly, the bank faced exactly the kind of acute liquidity crisis that can destroy even a fundamentally solvent institution within a matter of days, regardless of the underlying value of its long-term assets, simply because those assets cannot be converted to cash quickly enough to meet a sudden, large-scale wave of withdrawal requests. On September 25, 2008, federal regulators seized Washington Mutual and sold its banking operations to Morgan Chase for roughly $1.9 billion, a fraction of the bank's value from just a few years earlier, and notably a transaction that, unlike several other major financial institution failures during the same crisis period, did not involve any direct federal bailout of WaMu's shareholders or bondholders, who were largely wiped out entirely in the collapse. It's worth sitting with the specific speed of WaMu's final collapse, because it illustrates something genuinely important about how modern bank runs actually unfold compared to the classic image most people carry of depositors lining up outside a branch. By 2008, the overwhelming majority of WaMu's deposit withdrawals happened electronically, through online banking transfers and wire transfers rather than customers physically showing up with withdrawal slips. This meant the run on WaMu's deposits could happen with a speed that would have been physically impossible in earlier eras of banking, when the sheer logistics of processing in-person withdrawals imposed a natural, if modest, brake on how quickly a bank's deposit base could actually shrink. In the roughly 10 days between the first serious signs of depositor panic and the bank's eventual seizure by regulators, WaMu reportedly lost billions of dollars in deposits, a pace of outflow that older banking regulations, designed around a slower, more physical banking system, simply hadn't anticipated needing to guard against. This detail matters for a reason beyond WaMu's specific history. It illustrates a genuinely modern vulnerability that reappeared with even greater speed and intensity during the Silicon Valley Bank collapse 15 years later. Digital banking, whatever conveniences it offers depositors day to day, also means that a genuine loss of confidence can translate into actual, executed withdrawals at a speed no bank's traditional liquidity planning was ever designed to survive. Here's an honest complication worth including, since Washington Mutual's specific collapse involved a notably different resolution than several comparable institutions failing around the same time. Unlike Bear Stearns, which received Federal Reserve facilitated support, and unlike several other major banks that received direct federal capital injections through the Troubled Asset Relief Program later that same year, Washington Mutual's shareholders and bondholders bore the full brunt of the losses with essentially no government support, a distinction that later became a point of significant academic and legal debate regarding the consistency, or apparent inconsistency, of how different failing institutions were treated during the broader 2008 crisis response. George S. Clason's advice about the fundamental danger of a financial strategy that depends entirely on one single, uninterrupted condition continuing indefinitely applies here as one of the starkest illustrations of exactly that principle at an institutional scale. Washington Mutual's option arm lending strategy worked precisely as designed for years, generating real profits and appearing entirely sound, right up until the one specific condition it depended on, continuously rising home prices, finally and predictably failed to hold, at which point the bank's underlying fragility became catastrophically visible almost overnight. This isn't a simple story about one uniquely reckless bank making an isolated bad decision. disconnected from the broader financial industry's practices during this same period. Washington Mutual's specific strategy reflected patterns present across a significant portion of the mortgage lending industry throughout the housing boom, and its collapse became historically significant specifically because of its sheer scale, the largest bank failure in American history by total assets, rather than because its underlying mistakes were fundamentally different from what many of its competitors were simultaneously doing. So here's a question worth sitting with. In your own financial strategy, is there a single, specific condition that everything else depends on remaining true? And have you genuinely stress-tested what happens to your position if that one specific condition eventually fails to hold? Before you leave, I want to hear from you. Have you ever built a financial plan around one specific assumption continuing indefinitely, only to discover later how fragile that entire plan actually was once that assumption was tested? Read a few comments before you go. Some of the most instructive stories on this channel come from people who've identified exactly this kind of single point of failure risk in their own financial planning before it became a genuine problem. Next week, I'll feature one thoughtful comment at the beginning of the video and send its author one of the books that inspired this channel. And if these documentaries help you think differently about money, you'll find a way to support future research in the description. Every contribution helps us buy books, access research, and keep this content free for everyone. Remember this. Washington Mutual didn't survive 119 years only to fail because of a single bad quarter. It failed because its entire strategy depended on one condition remaining true forever, and forever, it turns out, is a promise no market has ever actually kept.